Welcome to the 15-Minute Financial Feast podcast, bringing you 15-minute segments to help you retire with purpose on time. We're serving up food for thought and bread for the head. Are you hungry to learn? Here are your hosts, Mark Triplett and Troy Westendorf.
Hey everyone, Mark Triplett here.
Troy Westendorf.
This is your 15-minute financial feast. And Troy, this week we are serving up food for thought, bread for the head. And the topic is really specifically to help folks retire with purpose on time. And we're going to be talking specifically about what to do when the market gives us lemons and how can we turn that into lemonade. That's right. So the first thing we're really going to cover is what to do when the markets throw us lemons. What does that look like? What are some of the causes, and how do we recognize that this is an opportunity? And we'll cover three strategies that may sweeten things up a little bit for those folks who are impacted by it, and why calmer heads tend to prevail when you have choice and flexibility built into your portfolio. So let's talk about just market lemons in general. We know that the market goes up and the market goes down.
Correct. Generally markets historically go up over time, which we know that. The swifter the downturn often results in the swifter the recovery.
Yeah, we saw that just recently, right? With the pandemic last year, the market sold off in rapid fashion. I believe it was a historically short period of time to get to the downturn, peak to trough, back to break even. But then, the contrary, the tech bubble took about 3 years to materialize that whole downward slide, and then another 4.5 years to recover. So from 2000 to about July of 2007 for that to kind of flush itself out. So yeah, that swift nature of a downturn oftentimes will result in a swifter recovery and vice versa.
Right, and some of it, you talk about the systematic risk, some of that we don't have control over, right? So systematic risk is a pandemic, and the pandemic, you and I have absolutely no control over what the pandemic is going to do to the markets. Natural disasters, you got hurricanes. So far we haven't had a major hurricane this year, but you have the hurricane system, you have political unrest. You have market bubbles. You go back to political unrest, it doesn't necessarily mean in the United States. It can be China, it could be Korea, North Korea, you name it. There's a lot of things that affect the markets now that have very little to do with the U.S.
Yeah, we're in a global economy, and any one of these factors could create economic conditions where we see a market sell-off. And systemic market risk is different than investment risk. Mm-hmm. Investment risk is when you're concentrated in one particular investment, say one company, for example, and right. You've got a lot of risk consolidated in that one company, or concentrated rather in that one company. Most folks today are going to have some sort of diversified portfolio, particularly if they're invested in mutual funds. But systemic risk basically takes the entire market down. Some assets might suffer losses worse than others, mm-hmm. but it impacts everybody, and it's pretty hard to get out of the way of that because you never see those events really coming. They just kind of happen. So I think it's important that we look at those systemic market events, or some systemic risk events in the market, as opportunities as opposed to panicking. And the swifter the downturn, as we mentioned, that may trigger a panic selling that accelerates the pace. And we saw that during the pandemic last year. We saw late February asset prices started to sell off, and then it rapidly accelerated to the bottom mm-hmm. as people freaked out. And those folks that sold, particularly when we got into late March, early April, unfortunately, those folks that sold in a panic are the ones that get clobbered, and the folks that have calmer heads, cooler heads are the ones who prevailed in that situation. So how do we turn these events into opportunities? How do we effectively make lemonade out of the market lemons?
Well, we always say around here, you have to be a nice person. So
that's a good place to start, right?
It seems like it's easy enough to do, right? But you have to be a nice person. When people are wanting to sell, you have to be wanting to buy. When people are wanting to buy, you have to be willing to sell.
That's right. So like when the market is up and everybody's in a frenzy to buy and asset prices are kind of touching historical highs and there's a lot of fervor in the marketplace, that might be a time to say, hey, you know what? You want to buy what I've got? I'll sell you a little bit. Just be a nice person.
Right.
Doesn't mean you liquidate your portfolio, but maybe you do a little profit taking. And then when when the market's falling and it seems that panic has set in and everybody's freaking out wanting to offload what they have, just be in a position to be a nice person and say, okay, I'll buy a little of what you have. That doesn't mean you go out and gobble up every asset that you can get, but maybe you take some of your money that you had sitting on the sidelines, dollars that maybe were either in cash purposely or maybe in a loss avoidance strategy, for example, where you can take a percentage of that out. Yeah, we call that dry powder around here. You take that dry powder and you go and you purchase those depreciated assets, knowing that like these companies aren't necessarily going out of business. There's nothing fundamentally wrong with them. They just got sucked down in the mud with everything else because of the systemic event. So that's one way. It's just to be a nice person. Another way, Troy, would be
Roth Conversions, which we talked heavily about this last year during this pandemic. We really took advantage of the Roth Conversions, which meaning taking some of your IRA dollars, paying the tax that'll, after that drop, paying your tax on that after it's dropped, and then those gains come back, I'll never tax again.
Yeah. So imagine if you had a $100,000 IRA balance, for example, and I won't use specific numbers, but if you started with a balance of 100,000, and let's say that the market fell by a third, so the value of your IRA dropped by a third. Well, if you convert that IRA at that time, you're responsible for paying taxes on 2/3 of that IRA, not the original amount you started with. You're responsible to pay taxes based on the market value of the assets in your IRA at the close of business the day you do the conversion. And then when those asset prices recover, as they did, and then some, right? The market has accelerated beyond the recovery of last year. Yep. Those account values now become tax-free forever, and all of that growth and appreciation on those assets that you converted when they were depressed become tax-free as a Roth IRA. So it's a great time to do that. And you can do this at the account level. You can go into a very specific IRA account and just say, I'm going to convert those assets, or you can convert a portion of those assets. Or we could even go like a surgeon in with a scalpel and specifically look at individual assets themselves. We're talking very, very specifically going in and looking at the asset level and converting specific depreciated assets. Like, for example, a year ago, some of the portfolios might have had, let's say they had energy stocks, oil, things like that, or airline stocks, or even travel, hotels and things like that. Well, Hilton didn't go out of business, right? So those asset prices were severely depressed, and imagine converting those when they were just, at the bargain basement price of converting that asset level, and basically getting the IRS out of your back pocket for the rest of your life while those were depressed, and now they've recovered, and then you would have all of that recovery would be tax free going forward. So anyway, just being strategic about how and when you do Roth conversions during a severe downturn like that is one way to really make lemonade out of market lemons. And
those were two, Mark, where you talk about that. We weren't selling off or buying some other stock. We were basically saying, like you did with Hilton, hanging on to that, taking it from one spot to another, and letting the price increase.
Yeah, you don't have to sell the position. That's a good point. We're not talking about necessarily selling out of a position and then converting the cash. We're talking about taking the actual asset itself, the investment itself, and moving it from one account, an IRA that's forever taxed, to Roth IRA, and you slide it from one to the other, and then you're responsible for paying taxes based on the market value of the asset the day that you convert it. And so I think having a calm mind is so important during a market sell-off like that, knowing that you're structured in a way that your resources are, even if they're impacted by the downturn, it's not going to impact your long-term outlook because you don't have everything subject to that market risk. And that allows you to have a calmer head and take advantage of these opportunities. The last one on our list is to harvest losses against gains in your after-tax accounts. And so this presents itself For example, let's say you've got a high concentration in a particular position, like say Microsoft or something like that, and we have a systemic market downturn, and it drags all across the market. All of these different investments kind of get sucked down into the mud, and maybe you want to take the opportunity to diversify out of that position, selling some of that and offsetting the capital gains that you might have on that position with losses on other positions that you have, effectively doing that without creating a taxable event, or at least minimizing any taxation, and then being able to diversify out into a broader portfolio and get some of that concentration of that one position out into other areas of the market that might be depressed assets. It might be a good opportunity to take advantage of those, right? So just those are three different ways that we see if we have a major sell-off, that we start looking for ways to guide clients to make good, healthy decisions, not panic, but rather see this as an opportunity versus something to be fearful of. And when you're in that position, when you've got that position of strength, you can make better decisions and take advantage of these opportunities and make lemonade out of market lemons.
Yeah, I think that's a good point, Mark. When you plan for this, when you plan for the market to make lemons, which we know it will do, and it will do it again. We just went through it recently, but it will do it again. The more you are prepared, the better off you can handle these situations without panicking and doing things out of fear, knowing that you have a plan in place.
It seems like we have these type of events, every 7 to 15 years.
Yeah.
Right? And many of the folks that might be listening to this, or folks that are nearing retirement, making that transition from their working years to their post-working years, they're going to have maybe a 25, 30-year retirement or longer. Okay, they're probably going to see events like this happen at least 2 to 3 times, if not more, during their retirement years. And so being in a position of strength to take advantage of this, based on a well-designed written retirement plan, where you have your assets kind of parceled out into different levels of risk based on your purpose and the timeline at which you're going to need those dollars. What is the purpose of the dollar? What's the timeline of the dollar?
Right.
And making sure that you're in a position to take advantage of these opportunities when they happen rather than panic is so critical. And it does take a fair amount of planning. It's not something you just kind of do on a whim.
Right.
But when you have that confidence of a written retirement plan that guides you in kind of from where you are today to where you want to go, and helps guide those decisions based in principles, founded in principles, then that tends to give you a little clearer mind when we have these type of downturns. In fact, I remember that, and I get so excited about this when folks recognize that it's an opportunity, because to me that tells us that we've done a good job of prepping them. When they're not freaking out, they're actually calling us and saying, "Hey, is this a good time to do that conversion, or is this a good time to buy into some positions with some of the cash that we have?" That tells me that we've done a really good job of preparing them so that they're not panicked, and that they're feeling like they're coming from a position of strength, and really counterintuitive to what it seems like the rest of society is doing at the time.
It is,
so,
really.
Anyway, that's it for our podcast this week. I hope this 15 minutes financial feast was of value to you. If you have questions about anything we covered today, you can reach out to us through our website at www.mypt5.com. That's mypt, the number 5.com. And you can submit a question there, and we'll answer that for you. And just remember, you can be somebody's superhero. There are many folks that are struggling right now to answer financial-related questions during this difficult time, and they may be trying to prepare to make that transition from their working years to post-working years. And there's a lot of confusion with regard to that. They don't have to go about this alone. There are financial professionals out there that do have a good comprehension of how to make that transition, and they can be guided through that. And you can send them to that website as well. And last but not least, we just want to remind everybody that around here we have a philosophy. We call it Purpose and Timeline. We do believe that every dollar has a purpose.
Every dollar has a timeline.
And until next time, be sure you're taking steps to retire with purpose on time.
You've been listening to the 15-Minute Financial Feast podcast. Remember, every dollar has a purpose and every dollar has a timeline. If you have questions about today's topic, schedule a call with a team member. Visit www.mypt5.com. Until next time, be sure you're taking steps to retire with purpose on time. Mark Triplett is an investment advisor representative of and advisory services offered through Royal Fund Management, LLC, an SEC-registered investment advisor. Nothing contained in this program should be considered an offer to buy or sell securities. Different investments have different risks associated with them, and not all investments are appropriate for all investors.